live. Today is our last live for July, and we're going to be talking about really what's happening in the market right now and why you should pay attention to it and what you should be thinking about as it relates to the future of the market. That is. With that being said, Leon's going to tell you why we chose this topic. I'm going to do, as I always do, a little bit of housekeeping.
So most of you that follow the market pretty closely, and maybe even if you don't, right now the market is down. The market's down roughly anywhere from, let's say, 6 to 10%, depending on tech stocks, non-tech stocks. Let's say an average, average of 8%. Say roughly 8%. The general market is down. And we put out last week to our community saying, hey, everyone loves discounts, right? But what's always crazy to me is we love discounts when we go to the store, when we're going, shopping for a car, house, whatever. But when the stock market becomes discounted, everyone gets scared and runs the other way.
Well, hey Leon, I think this is one of the things we can talk about. Most people don't look at investing like shopping, but they should.
Yes.
To a degree.
To a degree. Right.
And it becomes mindset. Like when we're shopping, we want the best deal. When we're investing, we sometimes get caught up in the confusion of research versus decision paralysis. And there is a very specific line of thinking that leads a lot of people into decision paralysis. I mean, and I know anecdotally, I'm going to tell this quick story. I was at a networking event last night, and these are high-level professionals. And, we're talking about government contracting and things really in the government space. But the conversation kind of drifted around finance. And then, I heard two of the people when we were talking, I mean, again, very highly accomplished international government contracting people, individuals, essentially saying, I don't have enough time to, do all the investing that I want because it requires so much research. And so my question became, what is so much research? And they really couldn't explain what they meant by research. And so, I just say that to say, but when you talk about going shopping, people are like, okay, I just need my keys and I know I need to know where the deals are. And I'm going to probably go to where the deals are if it's matched with two things, what I want and where the deal is. People don't just buy deals because some do. But normally people won't just buy deals because they exist. They want to match a deal with the item that they wanted anyway. And think about those two things when we're talking about the market today. Is there a deal and is there an item that you already wanted to purchase? I.e., in this case, a stock.
Right. And to that point, what again still amazes me is that people will have in their portfolios already, like you said, something that they want, right? So they already own a particular stock. And let's say it's even a stock like the big boys, Microsoft's, Home Depot's, Lowe's, whatever. Household names that we know with a high level of certainty that these aren't going to be going away in the next 3 to 5 years. These are multi-billion-dollar companies, right? But even when the market pulls back, a lot of people, not everybody, but a lot of people are still scared. And like you said, you made the point about people, they shop for what they want, and that's one big thing. But another portion of this is also fear. And to your point, again, you own a stock, you've owned it for maybe a couple of years, but when it's down 50%, people get scared. They're like, oh my God, the market's crashing, it's going to zero, that whole thing. And that's always been crazy to me. And now, and what we're going to cover today is I'm just going to highlight some of the past market downturns, crashes, whatever you want to call it, just big moves in the market down, and then the subsequent recoveries over the next 5 to 10 years. So like Brent and I always say, if you buy a stock, look to hold it for minimum 3 years. But we generally look, we're looking probably 5+ years out that you should look to own a stock. So I'm going to show again right now, and back to my point earlier. My point was last week we sent out to our community saying, hey, this is the time, right? Like this is go time. Market's down anywhere from 5 to 10%. Some individual stocks are down over 20%, right? They're in bear market territory, which again is awesome from a long-term perspective. Short-term, yeah, it's painful. Like my account is, I'm getting crushed not crushed, but I'm getting hit hard right now. But I've been buying, a few times the past 2 weeks. And I'm going to do some more buying today. So, because again, I know history, I know generally how the market acts. And what I'm going to read off to you today is kind of what I always fall back on. So I'm going to look down on my phone to get this information. So
also, when you're all listening to this, I would even suggest pulling up your account. and this is something we normally don't say when we do our lives, but you know, make it an actual activity today. Like pull up your account, look at the stocks that you have while we're having this conversation, and then just kind of play around in there. You know, click on it's going to be a button inside of anybody's portfolio, whether you're using E-Trade, Fidelity, Robinhood, whatever. There's a button that normally says chart. Click that button, and while we're talking, check the 6 month, check the 1 year, check the 5 year on some of these, and just kind of look at the variance of how these stocks really move and what happens when you go from a year to 2 years to 3 years. Really, we look at 3 to 5, but you know, play with it. I also want to say this: this is the moment where day traders get crushed. And this is the market where a lot of times, and why you always hear Leon and I say we don't support day trading. You can absolutely make money in it. I know we're probably gonna get an onslaught of comments from this and people texting us. That's cool. But in general, most retail investors, day traders, I'm talking about retail investors, don't have a system in place that will sustain a profitable day trading strategy. And for you day traders, I would challenge most of the day traders out there, when you get into a groove, market events like this occur, and you don't know what directions to play. Like directionally, things change, and for you option traders too. Like this is when directions change, and it's hard to navigate a new direction. Yes, you knew exactly what you were doing when it was this very linear path forward, and it was a market that was pretty steady. But as soon as it gets choppy, I'll say choppy, all of a sudden directionally, you don't know how to play that position or that strategy in the options market. And day traders a lot of times are novice. You know, let's just call it what it is. There's a lot of people who just got into day trading because they thought it was cool. And right now, the separation occurs with the people who actually know how to invest and the people that were kind of guessing their way to success. So just want to point that out.
Yeah, and before we do this, just on the options point, we know a lot of people love options. So I trade options too. And I trade them, typically trade them around positions already owned, stocks already owned. But I have not touched options in the last month. I mean, it goes back to what Brent just said, right? The market's been choppy, right? And options are a finite instrument in that, like we always say, time is on our side. Like if you buy a stock, you hold it in perpetuity, you can go up and down over the next 10, 20 years. It's likely going to go up. We know that about how the market works. But an option, you typically have anywhere from 30 to 60 days to be right. And if you're not right in that period, you lose money. So the choppiness of the market, I've stepped back from options over the last month. I'm gonna wait till the market settles out and then resumes its uptrend, and then I'll jump back into options. But in the short term, no, I'm not touching options right now, just because, again, as Brent said, it's been very choppy. Yep. And just as an FYI to any options traders out there, something to look at. Okay, so regarding the market being down right now, and why Brent and I always say these are the best buying opportunities that you can find in the market. So I'm gonna go back about 40 years, then I'm gonna go back even further, just to show that this lasts over time. So going back to the crash of 1987, which they call Black Monday, the market was down 35% in over was a couple weeks or a couple months that it was down. But let's say for Black Monday, the crash of 1987, market was down 35%. 1 year later, just 1 year later, the market was up 93%. And then, sorry, take it back. 5 years later, the market was up 93%. 10 years later, the market was up 335%. So I'll say that again. The market was down 33% during the crash of 1987. 5 years later, the market was up 93%. 10 years later, the market was up 335%. That was the crash of 87. Now I'm going to jump to the dot-com bubble. A lot of us remember that. Brent and I, showing our age often. We were actually trading, buying, and investing back then during the dot-com. So the dot-com.
We were in college, though. Let's just.
Yeah. I mean, we were right. We weren't like family men and anything. Yeah, we were in college, high school, college. So the dot-com bubble, or that era, lasted really from 94 to 2021. 2001. Yeah, 2001. Sorry, 2001. So the dot-com crash, the market dropped 50%, 50%. 5 years later, the market was up 102%. 10 years later, the market was up 86%. So again, if you had invested, and like, we're not just saying like Brent and I are these savants who know what the market is going to do in the next 5 or 10 years. We have no idea, right? But we depend on history, how the market has acted in the past. And also, we get it. It's hard as hell to buy when the market is down 20, 30, 40%. We understand it because your account looks terrible. However, we're just giving a high-level perspective on why it's good to buy, if you can, why it's good to buy when the market is down big. So that was dot-com bubble. Now the global financial crisis, 08, 09, even an even bigger drop. The market was down 57% during that time period. 5 years later, the market was up 178%. 10 years later, the market was up 306%. So again, huge returns if you can buy when the market is lower. Now, the most recent one, the crash, the crash of right. COVID was before the last one. COVID, the market was down 34%. And the data I have here is only through the year after. So this is probably through 2021. So COVID crash was 2020, market was down 34%. A year later, the market was up 75%. Now, I was saying the most recent one is the inflation drop in 2022. So the market in 2022 was down 25%. 1 year later, the market was up 22%. Now, people say, oh, that's recency bias, electronic markets, yada, yada, yada. Well, I'm going to go back almost 100 years. Great Depression, right? So Great Depression was
1929.
There you go, 1929, right? Lasted about 3 or 4 years. The market was Great Depression. I didn't realize this. The market was down 86% over that period. 86%. Now, 5 years later, the market after the Great Depression was up 265%. 10 years later, the market was up 86%. Now, what that tells us is that the 5-year return was 265%, and clearly the market pulled back from 286 after 5 years to being up 86 10 years. Regardless of that, the market was still up. It was still a great buying opportunity if you were able to buy in that huge downturn in the Great Depression. I'll give one last one again for recency, saying this is not recency bias. World War II, right? So World War II, the market was down 30%. 5 years later, after World War II, the market was up 71%. 10 years after World War II, the market was up 242%. So these are just a bunch of examples to show recently how the market has acted, and we can go back almost 100 years how the market has acted. We always say the market goes bottom left, upper right, right? Over time. Nothing's overnight, but over time. And these are examples of it. These are historic events. I mean, some of these are catastrophic world events that happened, and the market eventually recovered. Now, what's going on right now is the market there's nothing going on, right? The market this is just a general run-of-the-mill, profit-taking, summertime, people on vacation sort of market, right?
But it's also too related to we are going to an election. We are in an election year.
Election year, right? And actually, seasonality-wise, the market is typically down the second half of July, and it's pretty choppy through August. So what we're seeing right now is actually right on point with how the market generally acts for this time of the year. So
I think it will be different this year. I think we're going to see a choppy market until November.
Yeah. I mean, well, speaking of elections, election years, the market is actually up on average more than non-election years. So that's in our favor too. So again,
it normally happens in the after though. So the thing is, the market doesn't care who wins.
No, the year of elections, the market is typically higher.
No, reason being is the end of the year you're going to see.
It comes later, right? Yes.
So at the end of the year you see a spike, and normally the spike is higher because you have like the Santa Claus rally, but it's going to probably be a multiplier to that because the market really doesn't care who wins. They just want to know what direction the United States is going in.
Right, policy agenda. The market doesn't care. But it's a good point that it'll. So far the market has been acting for an election year the way it typically does. Again, time of the year, seasonality, the market's down. Great, as Brent said, the end of the year rally will probably be much bigger than it is in an off election year. Great point. So again, there's nothing really going on right now. There's no like catastrophic events that's causing this downturn. It's not even a big downturn, right? We're effectively down 8%. A correction is considered 10% or more. Bear market is considered 20% or more. So the market's fine right where it is right now. So this is a great buying opportunity. I've personally been buying over the last 2 weeks. I'm going to do probably some more today because the market is down again today. And I'm just looking forward to, if it goes down even further, I'm going to continue to buy. Again, dollar cost averaging into these buys. Nothing big, nothing major. Because again, I know generally based on history, as we just went through, the market, once it kind of corrects itself, will then, begin its uptrend again. And as Brent said, great point. In the election years, the recovery is actually usually bigger towards the end of the year than it is in an off year. So definitely, as Brent said, check your portfolios, do a review, see what you're down in, see what you want to hold for the long term, maybe buy some more.
Hey, Leon,
check your watch list.
Before we go too far into that, I do want to say we're hitting that whole baby boomer stretch where they're not only retired, but they're dependent on their money. This is a time where you have to think about protecting profits. So if a lot of the conversations we have go towards those people who have 10 years to give. But we should speak to the fact that there's some people who are retiring next year. And do they have time to look at a 5-year rally or a 10-year rally? You have to know how you're protecting your assets. And that is also contingent upon what's called your suitability. What suits your particular family's needs. So when you're listening to Leon now, we're saying 5 and 10 years. I know it's somebody out there thinking, I'm retiring in 2 years, but I can't afford to wait 5, or I'm retiring next year, or I'm in retirement. I don't want to play with my money. In any of those scenarios, you really want to think about what it is, what's your goal, what type of time frame do you have, how important are those funds to you, and maybe protecting some of it, moving some of it into something where you're getting dividends paying out. Like, are we looking at dividend paying stocks? We're not going to go into that now, but simply from a strategy standpoint, how are you managing your account is important, and understanding your particular time frame is something Leon and I don't know what your time frame is. So this is general information about recoveries in the market, looking at the year after, 3 years after, 5 years, and 10, in some cases, 10 years after. So all that to say, think about what your goal is, your time frame. Be smart. Don't be just completely scared of the market. Just be smart about how you invest in the market. And of course, if you're not part of a community, this is a great time to join Investing Education Academy, because it's really easy to do this on your own when the market is just continuing to go up. It becomes very scary to do this when you don't have a community and the market is going sideways and or down. So this is the moment where being in a community can stop you from doing something that could really hurt your portfolio in the long run. So I would suggest, of course, I'm biased, but joining Investing Education Academy. It's a lot of good information. If you were with us in 2021, like November specifically of 2021, there were a lot of predictions made on our end that were really on point. Leon, he did some research. I will give Leon his shout out, his flowers now. If you were part of that community, if you were part of our community at that time, we could have saved you a lot of heartache. So join the community if you're not part of one. Call your brokers, whoever you use. Get in contact with the companies themselves and just have a conversation. But either way, look at your portfolio. Don't be scared of the market. Historically, rewind this, listen to it again, and see if it makes sense. Go do your own research and continue to invest and make your money work for you.
Yep. And the moral of today is just take advantage of market pullbacks. Don't be scared. I mean, I just ticked through 4 or 5 of some of the biggest world events we've ever had. Market crashed and came back eventually 5 and 10 years later. So, we're talking about COVID, World War II, things like that. Right now, there's nothing like that really going on. I mean, there are issues in the world, but nothing catastrophic like that. This is a general pullback, 8%, roughly 8% pullback. Great buying opportunity. And just again, don't be scared of pullbacks. They are the best. They are the ways. And last point. Brent and I did a point on this before. That if you miss the 10 biggest up days in the market, you'll miss most of the gains in the market for that year. And the biggest 10 gains in the market typically come after some of the biggest down days in the market. Down days, down weeks, because nothing is typically that quick. So saying all that to say, probabilities, likelihood right now is that the biggest returns from this market will likely come out of this downturn right now. So it's another reason historically why you should be looking to buy right now if you can.
Yep. So with that, everybody, thank you for being with us. If you want to figure out how to become a member, you can go to ieanow.com. You can go to iamembers.com also to become a member, and just give it some time, see if you enjoy it. I think you will. It's a really good community, and we look forward to having you in it. Have a great day, everybody.
Well, don't forget.
We do owe you all 2 stock picks, and our picks will be inside of the Investing Education Academy community. So you need to be a member to see our stock picks now. You can, of course, become a member, and if you're already a member, just go to the site iamembers.com and log in. Everybody, have a great